Molina Healthcare just released their Q2 earnings report, in which the stock was down nearly 17% today after that earnings report, where they reported their earnings per share of $5.48, in which this missed analyst expectations, where analysts expected $5.53. While on the revenue, they did beat, where they reported $11.43 billion in revenue, which beat by about $486 million. So at least they did beat on the revenue, but the earnings per share came in a little bit short. But the huge takeaway from this earnings report wasn't just the miss on their earnings per share, but was lowering their full year financial guidance due to rising medical costs. Also, the company's medical care ratio during this quarter rose by almost 2%, going from 88.6% from the same quarter last year to all the way up to 90.4%. Meaning the company is spending more on their patients, which is lowering their profit margins. So this has been a very recent trend in health insurance companies due to higher medical costs and also lower government funding, because Molina Healthcare provides managed healthcare services through government-sponsored programs such as Medicaid and Medicare. So when the government spending is lower, this company is going to be making less, and also during this time, their profit margins are decreasing because of higher spending on their customers. So with this being said, with this huge decrease in stock price down nearly 17%, and with the stock down over 60% since its all-time highs, I'm be looking at the financial health of this company, and then later in the video, I'm gonna be using my intrinsic value calculator to see if we should be buying the stock today and to see how much I think we could make if we bought the stock at this price. The first two metrics I'm going to be looking at is the PE ratio, in which I'm going to be looking at the trailing P ratio and the forward P ratio. And for the trailing P ratio, I just want this to be greater than 0, meaning the company is profitable. And as we can see here, Molina Healthcare is a profitable company and trading at about a 9.38 P ratio. But as of today, with this recent drop, it's actually at about an 8 P ratio. So this looks very undervalued, especially compared to the stock market, and even in its industry seems pretty undervalued. So that's actually a good thing for Molina, and could mean that we could be buying at a pretty good discount. Now looking at the forward P ratio, I want the forward P ratio to be less than 30, which that means I want to be paying less than $30 for $1 of future earnings per share. And as we can see here, in the future, we would be only paying $8.60 for $1 of earnings per share in the next year. So we're going to be paying a pretty low price for this company for the amount of earnings it's going to give us when compared to the stock market. So far the two valuation metrics look pretty good for Molina. The next metric I'm going to be looking at is the revenue growth rate for Molina, and I want this to be growing at a greater than 5% rate over the next 5 years. And the reason I want this to be growing at greater than 5% rate is just to show us that the total sales of the company is increasing at a decent rate over time. And as we can see here, it is definitely increasing very fast, especially over the past 5 years, in which in 2020 they had about $17 billion in revenue, and now they have almost $42 billion in revenue. So this is a good check mark for Molina, and they're actually growing their revenue growth rate at about 19% each year. So this is actually very fast growth rate, especially for the industry and just overall. So I really like this about Molina. Now taking a look at the net income, I also want this to be growing at a greater than 5% rate, because we want to see how much profit this company is making and how much they get to keep at the end of the day. And as we can see here, they are also increasing over the past 5 years at about a 10% rate. So it is slower than the revenue growth, meaning the profit margins are decreasing over time, which is a pretty big red flag, but at least the net income is increasing at double digits. So this is good for Molina, but I would be worried about those profit margins. Now taking a look at the shares outstanding, I want them to be buying back shares each year. And the reason I want them to be buying back shares is because if a company buys back shares, we will actually own more of the company if we held during these times. Because since there's less shares outstanding, that means you will actually have a greater percentage of shares if you don't even buy any more shares. Because if you divide the shares of what you own by the total shares outstanding, if the total shares outstanding decrease, that means your percentage will go up. So we want to be owning more of the company, in which this will actually help the earnings per share go up over time and give us greater returns, especially if they're buying at good prices. And as we see here, it is decreasing over the past 5 years, but they haven't really been buying back over the past 3 years. But I'd like to see that they did buy back last quarter at a pretty good rate, and I hope they're buying back more today. And if they are, that's a good sign for the company company and that they believe that they can continue to grow in the future. So they are buying back over time, not at a very fast rate, but I would say at about 2% rate each year, since it was pretty flat for about 3 years. But this is good for Molina. Now taking a look at the balance sheet of Molina, in which I'm going to be taking a look at the total debt to equity ratio, which I want this less than 50%. If it's less than 50%, that means the company has more than double the amount of equity than compared to debt. But as we can see here, Molina has an 87.38% total debt to equity ratio. So this means compared to their equity, they have 0.87 times the amount of debt. So at least their total equity is greater than their debt. That's the good thing about Molina. But also, the very good thing I like about Molina is taking a look at the total cash. The total cash is $9.3 billion, and their total debt is only $3.77 billion. So they could pay this off right now if they really wanted to. And this balance sheet looks the best out of any health insurance company I've looked at. So far, Molina actually looks one of the best health insurance companies so far. So this is looking actually pretty good. And the final metric that I like to look at is the analyst expectations for their earnings per share growth rate over the next 5 years, in which I want to see this greater than 5%. And as we can see here, analysts expect them to grow at about 7.4% over the next 5 years. So that's actually not that good compared to what they've been doing, but at least it is greater than 5% and shows us that we can still make a decent return, especially if we buy this company at a good price. And with that being said, I'm going to be using my intrinsic value calculator in order to determine the price we should be paying for Molina and to see if we should be buying this after this huge dip in stock price. The first thing I have to look at is the future annual revenue growth rate for Molina, in which the only problem with Molina really in the future is their profit margins, in which they actually kept their revenue growth guidance for the future. So I still think that they're going to grow this revenue growth rate pretty fast. And I think that they can grow this revenue growth rate at about 7%. I'm still going to be pretty conservative with this company just because health insurance is having a real struggle, but I still think they can definitely get to 7% because over the past few years they're growing at 10 to 15%. I will expect a slowdown in this company's revenue, but I think 7% is reasonable. Now I'm going to be taking a look at the profit margin of the company and determining what I think the future profit margin will be in the next 10 years. And as we see over the past 5 years, they had a pretty high net profit margin at about 4% in 2020. But since then, we've seen a pretty big decline, and it's just been around 2 to 3%. And they just recently said that they're going to be having higher medical costs, and that's going to decrease their net profit margin. So with that being the case, I do think that the net profit margin probably won't be to 3%, but I think 2.5% is reasonable. But I do think in the next few years, we're going to see a pretty low net profit margin for this company. It could be about 1%, so you have to be careful with that. But I think in the next 10 years, they can get back to around what they were for the past few years, because I think in the long term these companies will be fine, but they do have some turbulence in the short term. Now for the future P ratio. Right now it's trading at about an 8 PE ratio, in which I think over the past it's been trading at about a 10 to 15. I think a fair future P ratio for Molina, growing at about 7% each year, I think the net profit margin will decrease this PE ratio. So I do think a fair PE ratio for this company could be 12. And that could be a little bit aggressive and could be a 10 PE ratio, but I'm going to say 12. Just because the revenue growth rate I think they can achieve, and also because I think they have a much better balance sheet compared to other insurance companies. I think they deserve a slight premium compared to those other insurance companies. Now for the shares outstanding. They were buying back shares actually decently over the past few years at about 2%, I would say. So let's say they buy back at about 2%. And with this being said, I actually get a future share price in the next 10 years at almost $560 per share, in which the current price is at $158. I think if you bought this today, you could potentially get a return of 13.47% annualized return, which would outperform the stock market. So with that being said, I think right now, valuation-wise, this company looks pretty good. And also, the financial health actually isn't too bad, but the guidance is the problem with this company, and me personally, I will be sitting out just a little bit. But I might be adding a starter position anytime soon. I do need to do some more research on this company, but it definitely does look more intriguing compared to some other insurance companies, especially because of the total cash this company has. Actually, the total cash is greater than the total market cap, so that's actually very interesting to see. I might have to dig deeper into that to see if that's actually actually true, but if it is, this could look like a pretty good price to buy the stock. So thank you guys for watching this on Molina Healthcare. Please subscribe, hit the like button, comment down below what stocks you want me to analyze next, and see ya.